Good morning, traders and investors. My name is Roger Scott, and I'm the Senior Strategist for Wealth Press. And welcome, welcome, welcome. Today's Tuesday. It's June 21st. We're coming off of a three-day weekend, a holiday weekend. It's about 7:43. The market's going to open up in about an hour and 40-ish minutes or so, give or take. My math is not as clear as it could be. I haven't had my coffee yet, my decaf. As you can see here, the Dow is up almost 500 points and the Nasdaq's up almost 200 points. Looks like we're having a little short covering after triple witching, which happened last Friday when we had option expirations, major option expirations. So market looks like it's getting stronger right now. I want to tell you what we're looking at today. We've got the existing home sales, and then we've got current accounts and PMI. But the big factor this week, really, what's going to be driving economy is going to be Jerome Powell speaking tomorrow at 9:30 and on Thursday at 10 a.m. and the consumer sentiment data, which is coming out on Friday. I think that's going to be huge. I think existing home sales and new home sales, I think the numbers have been fairly solid. So unless there's something really squirrely going on, I think we will be okay. Now, as I said, the futures are up pretty good right now, really good right now. It'll be very interesting to see if we could follow through. Another thing that's really interesting, that's really interesting, and when I say really interesting, I mean this may be the most interesting thing in the last 6 months, is if you look at the market on Friday, look at the three sectors that led the market. Communication services, remember I told you when it was turning around, when it was the weakest sector? Well, now it's the strongest sector on a month-to-month basis, or thereabouts. Consumer discretionary, technology. Do you guys see these sectors? Do you think, if you were to ask me what are the three most offensive, not defensive, but offensive discretionary sectors, I would say information technology, consumer discretionary, and communication services. And obviously, it's not energy and utilities and consumer staples. These are the most three defensive sectors. So that's Friday's trading action. Let's look at the last 5 days. Kind of mixed, right? Consumer discretionaries here, energy still at the bottom with utilities and materials, communication services is up here. How about 30 days? Let's look at the last 30 days. Well, energy and basic materials are also at the bottom, but you've got consumer discretionary starting to come up, and now look at where communication services is. So if you look at this on a cumulative basis or on a singular basis, there is definitely, without a question of a doubt, a major sector rotation happening right now. Now, if we go to my bar charts, on a cumulative basis, you still have defensive stocks leading. You've got energy, consumer, staples, utilities, three of the most defensive sectors, and you've got three of the most speculative sectors lagging. But let's now flip the script and look at it on a monthly basis. Technology is all the way up here. Communication services is halfway in between, and consumer discretionary is down here. Look at the last three sectors on a monthly, on a 30-day basis: utilities, consumer staples, and energies. Now, you can argue it's a temporary pullback, or you could argue that the VIX is not going higher. The VIX, the S&P, if you look at the S&P, look at the Dow Jones here. I want to show you this. Or let's look at the S&P. It's more broader. If you look at the S&P, which we're looking at right now, let me just flip this a little bit. Look at the slope here between the previous low and the new low. Like what, like 50, 60% slope? And look at it in the Russell 2000, the small caps, the ones that should be going down the most. Not nearly as much. This looks like maybe a 15% slope. I'm not a geometry expert, but it doesn't look anything like that. This looks like a roller coaster, right? The other one looks like just a soft landing, barely. So that's very significant because the Russell is the first sector to go down and the first sector to go up. Now, this is really important because if you look at volatility did not make a higher high. Remember, the S&P and Dow made a lower low, right? We just had the lowest low last week, but the index did not. The volatility did not, and volatility is almost at 30 now. It's down. Put the call ratio. Still, look at this. This whole area right here, this whole period is telling us that we are oversold, which means we are overdue for a strong rally. Again, the fact that small caps are moving higher, the fact that we're seeing the sectors starting to shift for the first time since January is very, very, very significant. So you need to pay attention to right now the Russell 2000. And hopefully if we don't break this low, and if we can come up to this level here, the 190 level on the Russell, there's a good chance that the worst may be behind us, or we might have made the low. But again, remember, markets are forward looking, and all of this Fed data that we're getting right now, there's a lag, a 6 to 9 month lag. So we could have already peaked out in inflation and not know it yet, because core inflation was not higher. Let's look a little bit about global economy, because we missed the last few days. Oil prices climbed again above $110 a barrel. The Friday market rose a little bit. It was down 5.8%, 10th drop in 11 weeks. Biggest weekly decline since March of 2020. And again, usually those type of shakeouts lead to reversals. Investors worry about U.S. and European central banks to cool inflation. That's running at a 4-decade high. We already know that. Japan and China are not doing the same thing U.S. is doing. They're letting their rates run low. They want to see what happens. They want to weaken the yen to see what will happen. It's a very interesting situation to see who comes out on top. But they got to stimulate the economy. Investors are looking for clues from the Fed this week about additional rate hike before Congress committee meets this week. And that's what I'm talking about right here. Jerome Powell speaks. So we're going to see how dovish or how bullish he is. But again, the volatility is very promising right now. Put the call ratio is very, very promising. This is a market that's stretched out like this, like really stretched out. Now, let's talk about the strongest sector, strongest stock, weakest sector, weakest stock, because that's what we're here for. It's Tuesday. Energy is still leading. Consumer discretionary is still lagging. We're going to respect that for the time being, because we use cumulative basis. And this could be a pullback or a shakeout, and we may go back to defensive nature of the market. It just depends if this bear market's going to continue or not. And by the way, we've got the 4th of July coming up, and I'll do some studies later today to show you how the markets actually become really bullish right around the 4th of July holiday. So you've got energy right here. Non-energy, Lamb Western Holdings, some medical stocks, but predominantly energy. You still have some Bristol-Myers, some Cigna. So you've got medical and energy, but I'm going to stick with energy, and I'll go with Occidental as the top stock. And it is energy. On the bottom, consumer discretionary, Royal Caribbean, Netflix. Folks, I am really bearish right now in this Bath and Body Works and Etsy. Those two stocks, Bath and Body Works and Etsy. It's going to be very, very interesting over the next few days to see how the market does. Let me give you guys some clues to what to look for. Keep your eye on the Russell 2000, and always keep an eye during the day if it's outperforming or underperforming the major indices. Like right now, it's up 1.94 before the opening bell. Let's see what the QQQs expected. 2.74, you see quite a bit. What about the Dow? 1.59, and again. So the Russell is expecting more gain than the Dow, but less than the NASDAQ. Let's look at the QQQ, the SPY, and less than the SPY. So the Russell is outperforming the SPY and the Dow. That's very, very significant. If we can maintain a stronger small cap market, and if we can get a shift on a cumulative basis, let me just show you a different chart. If we can move away on a month basis, if we can get on a cumulative basis, what we're seeing right here, the market is going to have a massive, massive turnaround. This is the first time, I don't know why Stock Fetcher isn't working, but this is the first time since January we're having such a major, major sector rotation. And if this sector rotation takes hold, this is going to be very, very significant. And I mean very, very, very significant. So you got to pay attention to these sectors and keep an eye and see how they're doing on a 5-day basis, and see whether energy is starting to lead, or if consumer and the energy and the industrial and basic materials are starting to lead. If you see this, if you see this over the next 30 days, communication, consumer, information tech, very, very bullish sign. If you see the small caps starting to lead, very, very bullish sign. If you see the put to call ratio continue to drop, very, very bullish sign. So we do have some things on the horizon, and cyclically, we tend to go up the period right before 4th of July and into the 4th of July tend to go higher. Now, before I let you guys go, wouldn't it be great to be able to predict future market direction, or even better, know the exact odds of a trade working out before you take action? Welcome to the digital age of algorithms, folks. I've spent the past 6 months running tests on my favorite leading indicator that's allowed me to pick up to five secret market patterns. And it's honestly a trading breakthrough. I'm even going as far as calling it a brand new way to trade. I've never seen anyone do this kind of testing before placing every trade. A way for us to ditch all forms of technical and fundamental analysis. Yes, ditch technical and fundamental analysis and only focus on 5 highly optimized chart patterns that have worked in history over the last 300 years and certainly over the last 10, 20, 30 years on the stock market. We've got complete evidence of that, empirical evidence. Only focus on 5 patterns. We threw away 59 patterns, and we had 64 to start with. We threw away 59 of them and got left with 5. Don't you want to know what they are? Don't you want to know how they could change your life? I would if I were you. Click on the link below because I'm going to give you all 5 patterns for free and show you their back test results on the S&P 500. Wouldn't that be cool? Follow the link below. Don't miss out. Tomorrow, I'm going to give you a short trade and a long trade. Post some comments, love letters, send me an email, support@marketgeeks.com. We may be very close to bottoming out here if what I'm saying holds true. Bye, guys. I'll talk to you soon. Have a great day. Last week might have been a shakeout.